Welcome, everyone, to Investing for Generational Wealth. Let us dive into the world of expert financial insights and strategies. Before we begin, a quick disclaimer. We're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest, so perform your due diligence before making any financial decisions. And of course, consult your CPA and attorney before beginning investments. My partner, John, and I, we just like to dress up fancy on Wednesdays and come talk to you. That's it. I'm your host, Keisha Kulor. I'm joined by my co-host, John Lai. Welcome to today's episode, Capital and Raising Structures. Today's guest is Randy. Randy, thank you for being on here with us today.
Yeah, glad to be here. Thanks so much for having me.
If you could give us a quick introduction about yourself, how you got to where you are today and what you're up to right now.
Yeah, absolutely. So I was a sales guy in corporate America for about 25 years. Spent the very large majority of that 25 years with two Fortune 100 and Fortune 200 organizations. And I led sales organizations, but spent the last almost 10 years of my career carrying the bag, as they say, out there meeting with clients and CFOs and CEOs, working in the financial services space. So I had kind of a unique situation where I got laid off about 10 years before I ended up officially leaving corporate America. And at that time, I didn't have any real estate investments. So after I moved into my next role and got a little bit of stability under me, I started investing in real estate and then found the passive investing space and went all in on that space, which led me to a position where I got laid off yet again in June of 22. And this time it was a little different, though. I had the majority of my household expenses covered by my passive income. So I didn't have to go back and chase another job or another W-2. So that's when I went all in on real estate investing and teaching others to do what I had done.
That's the dream.
That's the dream. Yeah.
All right. Well, kick us off. What do passive investors have to know about capital raising structures?
Yeah. So thank you, first of all, for having me on the show to talk about this. When I started in the passive investing space, I knew none of this. So I made a lot of mistakes early on and just assumed that every deal that came across my desk was structured the same, that the fees were the same, and that the entity structures and the protections and the benefits were all the same, regardless of what type of capital raising structure was being used. So that's why I put this presentation together, and hopefully it'll bring some value to your audience to learn a little bit about the ins and outs of what these structures look like. So we'll go ahead and just jump right in here. I've got my own disclosure as well. I know you mentioned it early on, but I'm not a CPA either. I'm not a tax guy. Certainly consult with your advisors before making any decisions. And what I have and what I'm going to share today is just my experience. I don't have any licensure. I don't have any credibility other than what I have done. So we'll leave that at that as well. So what am I going to cover today? I will spend a little bit more time with the bio. We did actually cover a large portion of it early on, but then I'm going to get into 5 different types of structures that the passive investor will see or come across as they continue on their passive investing journey. We'll start out with syndications, which is the most common model, co-GP. We'll look at this fund-to-fund model or fund of funds, which is really an emerging tool that's being used more and more, and it's what I leverage primarily in my interactions with my clients as well. We'll talk real briefly about the blind fund, the customizable fund, and then I'll kind of jump into some of like a specific example of what this can actually look like for the end user, the investor. So any questions before we jump into the content?
I would just assume that anyone who's listening might have just joined us today. So let's beginner friendly, basically. So
beginner friendly. I will try to make it as simple as possible.
Yeah.
But don't be afraid also, if there are more detailed questions, go ahead and throw those in either in the comment section or wherever you happen to be viewing or listening to this. So, all right. So let's go ahead and jump in. So my bio, you kind of heard the 20,000 foot view early on, but basically 25 years in corporate America. I, like a lot of folks, I started with the single family investing. That seemed like the most tangible, most easily understood investing strategy, which I think a lot of people do. You'll hear that more and more as you hang around this space. A lot of people start in single family. And I don't think you have to do that, but it certainly is where a lot of people start. So I started with 2 turnkey assets out of state. As we mentioned earlier, I'm actually based in Phoenix, Arizona, and it was not feasible to buy a single family home in Phoenix, Arizona and have that cash flow from day one. So I ended up having to go out of state to do that, because ultimately I was, yes, trying to grow wealth, but I was also trying to create cash flow, which would ultimately offset or decrease my dependence on my W-2 income. So I found that in Kansas City at first. Um, I leveraged a turnkey model, which, if you're not familiar with that term, by definition, it's supposed to mean that you buy an asset, or you buy a single family home, they have a renter in it, it's already been renovated. And generally in the turnkey space, you're hoping that you don't have a lot of renovations out of the gate because it's been renovated. And I will just share that that was not my experience at all. It was anything but turnkey. And I learned a lot of lessons on that. And what I learned more than anything was that I needed to be more involved in that process, or work with a different type of operator. So I moved then over to the BRRRR strategy in Atlanta. And for those that don't know what that is, it is buy, rehab, rent, refinance, and repeat. So you're buying single families, you're fixing them up, you're putting a renter in it. And then once you do that, you refinance and you pull all or most of your money out, and then you just leave it there as a renting unit. And that process actually worked really well. We created quite a bit of equity through those 4 different BRRRRs. We did have some funny stories and some challenges throughout that process, but all in all, we ended up with 6 total assets after just a couple of years, which, when I ended up selling those, it ended up creating about, I think it was 500 or 600 grand in equity on those deals in a relatively short amount of time. So, what one might ask, like, if that was going so well, why didn't you continue it? And what happened was, one, COVID happened, which caused a lot of challenges. But probably more importantly than that, I found that to do or to create the portfolio that would kick off the cash flow that I would need to ultimately leave my W-2, I was going to have to do 50 homes either paid off or 100 homes that were financed. And after the blood, sweat, and tears that went into those 6 units, I just could not imagine doing that 50 or 100 times. So that's when I found the passive investing space. So I started investing in Kashav. Is the audience familiar with passive investing, or should we get into what that looks like a little more detail? Or
Yeah, we could just always break it down at a high level, like 30-second blurb.
okay.
Yeah.
Yeah. So, I mean, ultimately, passive investing is where you find an operator that you know, like, and trust. More often than not, they've got a large organization behind them that is supporting the operations of a much larger asset. And then, as a passive investor, you just simply place capital into a specific offering or into a group of offerings, and then you get to share on the upside, whether it be through cash flow ongoing and or the equity upside when they sell those assets on the back end. So very high level of passive investors investing into real estate. You get most of the benefits of being a real estate owner, and you leave the blood, sweat, and tears and hard work and heartache to the operators to do that. So being a high income W-2 sales guy, um, it made more sense for me to be spending my time in my job because I could very easily equate hours to dollars. And the dollars I was generating in my W-2 were significantly more than I was generating in my effort in real estate. So the mindset was like, go do what I do best, go practice my superpower, which was sales and building relationships in that industry, and then take the dollars that I'm earning and handing it over to the experts in the real estate space where I felt the upside was much higher. So I invested very heavily as a passive investor. I'm now actually an LP or a limited partner passive investor in 25 different syndications, now 12 different operators and 7 different asset classes. And as I mentioned earlier, about halfway through that passive investing journey, I ended up getting laid off again, but most of my expenses were covered, so I didn't have to go back and chase another job. So that's when I launched Impact Equity. And our goal with Impact Equity is to educate and inspire the new or newer passive investor and help guide them through that passive investing journey and provide to them carefully vetted syndication passive opportunities across various regions, various asset classes, operators, and then business models as well. So in the last coming up on 2 years, we have formed now 5 partnerships with with other partners. We've done now 14 single asset funds, SPVs, as we were talking earlier. I've done a blind fund. I've done 3 co-GP and 1 debt fund. So I'm the right guy to talk about the differences between these and kind of the good and the bad and the ugly about the different opportunities there. So that's a brief overview of the bio. But any questions before we move on? All right. I said earlier that I didn't know if I was going to get to 45 minutes, but we might. It sounds like I'm talking today. So, all right. All right, well, let's go in. So we talked about this passive investing side, like the most common type of structure that you're going to see. And I think it's actually the same that Kashav and his partner use is a traditional syndication model. This is where you have, for those of you that can't see the visual here, you have a lead GP or general partner that's at the center. They are the experts at acquiring the assets, renovating the units, executing the business plan, whatever that may be. And then they use additional investor capital from their network to help fund those projects. And quite often what that looks like is they're going out to buy, say you're buying a $10 million apartment. For round numbers, maybe they're get a 70% loan to value on that asset. So they get a $7 million loan. And that means they need $3 million to bring to the closing table, plus some additional dollars probably to do early stage execution of that business plan. So they need $3 to $4 million before they can execute this strategy. And that's where they come to folks like you and I, the passive investors, to bring those dollars and then share on the inside or on the upside. So very basic model. You see a lot of these. We saw, I would say, more of these in the past than what I think we'll see in the future, because we're starting to see more of these other models. But very straightforward. You know, there are certain return structures, there are certain return metrics that you as an investor can expect. There's generally less people involved in the day-to-day operations of these business models. So you have maybe 2 or 3, maybe 4 or 5 people that are involved in the lead GP. And then, of course, they have their own teams that actually execute a lot of the work, but very small leadership groups. So it's closely knit. Everybody is extremely involved. Fee structures are very straightforward. And since it's only the GPs and the investors, there's limited risk from a structure standpoint. because there's just not a lot of variables there. So some of the cons of this type of model is that quite often what we've seen is that these type of syndications, I believe the number is like almost in the 90 percentile, are something that's called a 506B offering, which means that that they're only able to share those investment opportunities with their direct network, that they have an existing pre-existing relationship and a substantial relationship as well. So one of the cons from I guess from the investor and from the GP side is that it's very limited to their direct network or the networks that they've built up over time. So if you are an investor and you don't know Kashav and his team, you're not going to see his deals, ultimately, is what that means. So as an investor, you will generally have limited access to deals if you're only dealing in this space. I put in here that it has the potential for higher minimums. I say that because early on when I was in this space, um, there were a lot of $100,000 minimums. I saw $250,000 minimums. So it really limited the opportunity for me as a passive investor to get involved in those type of deals. And it makes sense. As the syndication group gets more experienced, they want to get bigger and bigger checks. So they start increasing those limits because $25,000 check writers, like I am and have been and probably will continue to be, we ask a lot of questions, and that can be rather labor intensive. So it makes sense as the groups get more proficient, they're going to kind of up the bar on that. So that's the basic syndication model. Any questions or any thoughts on that, Kashav and team or anyone?
I would
I
say,
have one question. Go ahead,
Yeah.
Kashav.
I was gonna say like 506B offerings, like you said, they can't be advertised. On the other hand, though, you do have to have a pre-existing relationship with them, like you said. And that's why a lot of people haven't heard about these opportunities that, a lot of times I talk to people for who this is new and they're like, this sounds too good to be true. And it's because you just haven't heard of it. And this is why we're legally not allowed to advertise these, publicly. And on the other hand, you have 506C, as in Charlie, those you can advertise. And, that's maybe might have become more popular because that only started in what, 2012 or 2013.
Mm-hmm.
But that in exchange for you being able to publicly advertise only allows for accredited investors, minimum net worth, minimum income requirements. So
yeah,
it's interesting though. I didn't know that 90% of deals were 506B. I thought it was more like 70%.
Yeah, I was shocked to hear there was an SEC panel at a conference that I was at last year sometime. So I was shocked to hear that as well. And I think it's such a valid point too. I was 45 years old before I knew what a syndication was. And it's just because of this. So yeah, very good.
Yeah. And even the 506B, I
Um,
think only came out in like the 1980s. So even that in the grand scheme of things, your parents, for those on the call, might not have heard. So
Mhm.
the question I had was, you talked about SPVs, special purpose vehicles. That is obviously not the capital structure, but that's just kind of the holding vehicle, right? Versus fund of funds or fund. So that applies to syndications and then as well as all the other capital structures you'll be talking about.
Yeah, absolutely. And we'll get into those other models a little bit more detail here to kind of compare and contrast those as well.
Yeah.
Perfect. All right. Okay, so let's jump into the co-GP model. And for those of you that don't have a visual in front of you, it actually looks very similar to traditional syndication model where you've got a lead general partner or the GP, and then you've got investors that are investing directly through them. But then it adds on these additional arms, and it can be 2, 3, 5. Unfortunately, we saw as many as 20 or 30 in some situations, where a co-GP is brought in with the primary responsibility of bringing capital into those investments, with the caveat that the SEC requires even the co-GPs to have material involvement in the day-to-day operations and management of that investment. So very similar structure, but you have more people that are involved in the general partnership. And those that are involved in the general partnership have varying levels of involvement in the day-to-day operations. I'll share that as kind of a general idea as to what the co-GP model looks like. Now, let's talk about the pros here. The general partner benefits because they're now getting access to the networks of the co-GPs as well. So if John and Bob bring on 6 other co-GPs, those 6 other co-GPs could have access to hundreds or even thousands of other investors that would then, if it's a 506B environment, it would allow the deal to get exposed to significantly more individuals that have a pre-existing and substantive relationship with the general partners. So by adding co-GPs, that audience gets much bigger. I would say that this model is likely a little more easy for investors to understand than some of the other models that we'll get into and to discuss, because it's really just one legal entity that is the main general partner. There's not different fee structures. There's not different legal paperwork that is built into these. And it's just a little simple structurally. And probably one of the biggest things is that there aren't additional fees and legal costs that are built into these structures because it is just one entity. So this was a model that was used very heavily for years and years. We're seeing this start to show up less because ultimately the biggest con here is that the SEC frowns on this. And the reason they do frown on this is that material involvement that's required because there are things that are called broker-dealer laws that if you just pay somebody to bring capital to a deal, then you're violating broker-dealer laws. And that's a big no-no. The SEC frowns upon it. And in fact, a lot of general partners have gotten in a lot of trouble and actually paid some very significant fines in recent years because those co-GPs did not have material involvement that was easy to identify and explain when the SEC came asking questions, essentially. So that's the biggest con here. And I think probably why we'll see less and less of these occurring. And it's that whole idea that, too many chefs or too many cooks in the kitchen. It's hard to kind of manage that process and make sure that everybody's operating, within the guidelines that are set up by the SEC. So let's see here. Again, kind of a con. The investors that are coming to these, they're going to get the same returns as to whether they were investing directly with the lead GP or the co-GP. So there's no beneficial economics that occur there. You deal with the minimums again, where it has the potential of having higher minimums. And then from an investor standpoint, if you're only dealing with a multiple of general partners, it's likely that as an investor, you're going to have multiple portals you have to log into to get access to all of those deals. So this is the co-GP model, very similar to the syndication model. But again, I think we're going to see less and less of these just simply because of the SEC's kind of distaste for the structure. Okay. All right, so let's jump.
We had a question come. Someone asked, what is the optimal number of co-GPs to stay under the radar? Where's the fine line?
So air quotes, I'm not an attorney. Please talk to your SEC attorney. But I've heard that 4 is kind of the magic number. Or that's at least the guidance that I've received from multiple SEC attorneys. Could you do, I think it's easier to say when I'm talking with folks, like, if you're an operator and you're doing flips or you're buying multifamily and you bring in one person, it's pretty easy to call that a JV. If you bring in 10 or 15 or 20, Much more difficult to call that a JV or co-GP. If you're in that 2 to 4 range, you're probably okay. But above that, I don't know. I would strongly encourage you to consult with your team, your legal team.
And can you point us to specific SEC broker-dealer regulations? Where can we go to learn more about the regulations around capital raising?
Yeah, so the best source is sec.gov ultimately. If you do a search, there are specific pages, I don't know them off the top of my head, but if you do a search for 506B or 506C, there's a couple of landing pages that will be towards the top of the Google search that are a really good reference for, general guidelines and definitions. But again, there's not been, my understanding is there has not been a lot of rulings in this space yet. But the rulings have clearly shown SEC attorneys to be more cautious in this area and to steer away from this type of model is what I am hearing. And what I'm seeing in the marketplace being pretty heavily involved in this area for a number of years.
I would say in general, just look up real estate syndication attorneys or someone. I'm sure a lot of them do free consultations, so check them out. And yeah, Randy, to your point, I think when the market's doing well and everyone's getting their returns, no one calls up the SEC.
Yeah.
At the state, you can call them up at the state or the national level, I believe. I think more so state though. But once we start seeing deals go sideways, we've already seen some go sideways. Others believe that we haven't even seen the pain and much of this distress just yet, which I feel like is also true.
Yep.
So the SEC might be getting more business here soon enough.
I got a feeling. Yeah, I got a feeling there's going to be more. And, transparently, I sat through in the last 48 hours 2 different capital call webinars with investments that I made early on. So if you've not been impacted or you haven't heard of it, you likely will be soon. So.
And a capital call for those listening is basically anytime these syndications or private equity opportunities in general, all of your capital's contributed up front at once for the most part. It's not like the stock market where you get to reinvest the returns back into the deal. Again, for the most part, some deals that is the case. So you're supposed to have all the capital you should need up front, but markets change, things happen at the property, things you don't account for, especially less experienced groups. You need more money than you initially thought. The GPs, general partners, do. And at that point, they do a capital call, basically asking investors, hey, we need more capital, which means either the existing investors come out of pocket more to hit the same returns, or new investors are brought on and their shares are diluted. Neither situation is really something that existing investors are happy about. So,
Right. Good point. All right. Well, let's jump on to another model, which is called fund of fund, fund of funds. It's called a number of different things, but it's very similar in visual structure as compared to the co-GP. The simple difference here is that you've got a lead GP in the center who's still raising from their current investors. And then you have fund managers who have their own funds that are raising capital from their investors into their funds. And then that fund places the capital into the opportunity with the lead GP with one check generally. And more often than not, when you see this type of environment, the funds are actually receiving preferential economics or better returns than the traditional retail investor is receiving, just simply because they're bringing a bigger check to the table. And as we discussed earlier, if you either as an investor or a fund manager are bringing a bigger check to an opportunity, it behooves the operator to pay better terms, better returns, better economics to them because they don't have to deal with the investor relations that they would need to if they were getting 50 checks at $25,000 versus getting $1 million check. So similar in nature in that the benefits to the operator are similar in that, they're getting access to additional networks through their fund managers. They're also getting larger checks versus having to get multiple smaller checks. And as an investor, there are a lot of benefits by dealing with fund managers because quite often you can get the same type of diversification that you would need to go through 3 or 5 or 10 different operators, you could get through one fund manager. And that's the type of diversification that I shared we offer through impact equity, which is operator diversification, geography diversification, asset class. So fund managers quite often are asset class agnostic, and then also business plan or business model agnostic. So they could do value add, they could do development. Essentially, by having one relationship with a fund manager, you could manage a fairly diversified portfolio because of the work that they're doing to find good deals and good opportunities for you. So again, we've talked about the fact that fund managers will often get, or the funds will often receive better economics because we're bringing a bigger check. And more often than not, those better economics are going to flow through to the end level investor. Now, it is important to note that just because the fund is earning better returns, that doesn't necessarily mean that the investors are getting better returns, because the fund manager decides what portion of the fund earnings flow through to the investors. So we'll walk through an example on the end to kind of show you how that works. But just be aware, if you're dealing with a fund manager, there is another entity that's involved. There are additional expenses and legal work and paperwork that's involved. And it is possible that the returns could be better going directly to the lead GP than investing through that fund manager. Okay. All right. A couple of the other benefits here, and this is just based on example. This is not always the case. And I would say the majority of the things that I'm sharing are never black and white, always the case, or always not the case. But in my experience with the operators that I work with, since I'm bringing a bigger check to the table, quite often they will give me a longer window to raise and bring investors into those deals. And what that might look like is that you'll see quite often operators launching deals, and then sometimes within hours, certainly within days, they'll say that the fund is full or the opportunity is full. But they're full because they have soft commit from fund managers as well. So it's kind of an optic play, I believe, by a lot of the operators that are doing that. But just know that just because the operator is saying it's full doesn't mean that they funded everything. And it's possible that those soft commits are coming from fund managers that still are going out there and raising that capital. More often than not, with the funds that I work on, I will generally have about 45 days to raise those funds, just simply because I've got longstanding relationships with those operators. Okay. Probably the biggest benefit, and this kind of ties to the diversification piece that we discussed earlier, is as an investor, if you work with a handful of fund managers, you're just going to have a very large amount of deal flow coming to you, because those fund managers they spend all day, every day vetting deals, vetting operators, and trying to put consistent deal flow in front of their investors. And then lastly, probably the biggest benefit for folks that are just getting started in the space is fund managers will generally be more lenient with their minimum investment size. So it's not uncommon to see $25,000 minimums. I've even seen some situations where investor or fund managers will take as little as $10,000. Okay. So those are some of the benefits. Some of the cons in this is anytime you add another layer in an investment entity, there are added risks that are involved. When you are doing or vetting an operator and you only have to vet 3 of the people in the GP, that's one thing. But when you have to vet the fund manager as well, it's important to dig into who that fund manager is and make sure you're doing your due diligence on them as well. There's a fairly low cost to entry into the fund to fund world. So there are a lot of folks that are playing in this space that might not have the tenure and track record that the operators that they are raising for have. So it's possible for a deal to be doing very, very well at the lead GP level, and for there still to be issues with the fund management through the fund to fund model. So that's important to look into as well. Another con in this area is that when you're dealing with fund managers, you have additional legal work and additional legal fees that are brought into this place. It's not uncommon to see the fund manager fees just for legal expenses alone can be $5,000 to $10,000 or even $15,000 per project. So those fees get paid through the funds of investors before those dollars are invested into the opportunity. There's also quite often acquisition fees that the fund managers are charging, sometimes asset management fees. Certainly there are equity splits that are involved, and we'll dig into an example so you can see what those look like. But it's really important not only to dig into the lead GP fee structure, but also in the fund fee structure as well. And then, with that added level of complexity and added entities, delays in reporting and distributions and K1s can occur, because distribution K1s and updates need to flow through to the fund manager, and then the fund manager needs to have those same things flow to their investors. So there are extra steps which can cause delays in all of those as well. So if you're dealing with a fund manager, make sure you're working with a seasoned and experienced one that has systems and tools in place to make sure all of that's happening seamlessly. And then one final con, when I first got started in this space, I had 4 different operators, and I had investors that literally had 4 different portals they were investing into, even though they were investing with me. So we've since moved over to one centralized portal model where all of my offerings go through one portal, which then really becomes a pro, where you can get access to all of these deals and only use one portal. So that was a mouthful. I am thinking about the structure of this slide. It could probably be like 8 slides. I apologize for throwing so much, but I think it's important for investors to know all of this when investing with fund to fund managers. So wouldn't be surprised if there were some questions there, but curious at least your thoughts, Kashav and John as well.
So we do have a question that came in. I think you addressed it, but what kind of carry is usual at these fund levels?
Yeah. So if by carry, are you talking about the fees that they're charging and what the fund is earning?
Yep.
Yeah. So is it?
And I would imagine it's mostly the fund itself is what's asked with the question, like what fund fees are there besides, I guess, the legal fees?
Yeah. So and maybe we'll answer both ways, because I think both are important. We talked about the legal fees. I can share with you as well that in my funds we have portal fees that get billed back to the fund. We have banking and accounting fees that get billed back to the K1, and we also have tax prep and K1 prep that's billed back to the funds as well. So those are all expenses that come out of the fund earnings before investors are paid. Okay. And just to share an example there, in year 1, with one of the operators I was working with, they were charging $400 for tax prep. And the next year, that $400 per fund fee went up to $2,000. So if we made the decision to go external with our tax prep and partnership versus leveraging the ones that they suggested, but be aware that there are fees there that you want to make sure you have somebody who is being a good steward of your dollars and the fund's dollars as well, not just spending it because it's fund earnings. So from a high level overview on like how much is the fund manager earning, the general rule of thumb is that the fund manager is going to be earning about 10% of what the capital is that's raised. The very large majority of that in most situations is going to come on the back end. And in most of my opportunities, just to share transparently, I charge a 2% acquisition fee on the front end. And then I charge usually an 85-15 split in the promote on the back end. So we've also started charging a 0.5% asset management fee. And the reason we're doing that is that early on we were starving the fund and did not have the resources to put the systems and the tools in place to make sure it ran seamlessly. So we're doing an AUM fee now just to cover the cost of day-to-day management of the fund. Whereas early on, I was trying to give every dollar to the investor, and I think I was doing that at the detriment of the investor. So we are starting to see situations where that 10% number is actually getting larger because you're seeing, I'm using this term called like army of fund managers, air quotes, where you're getting larger groups of fund managers coming together to bring significantly larger checks. We're talking 2, 3, 5 million, $10 million checks. And going back to that initial principle, like as those checks get bigger, they demand better economics and returns. So if an operator can rely on an army of fund managers to bring all of the capital, it's not surprising that they're asking for a bigger piece of the pie. So that 10% I've heard can be as high as, 15, 18, or even 20%. But again, it's dependent on the size of the check.
I would usually say the goal of the fund of funds is at least whatever terms the investor would have gotten if they had gone straight through to the operator without the fund. The same returns should try to be met within the fund as well. That's usually the goal. And that's why the fund gets a higher promote to account for the fees and overhead and obviously the fund manager's compensation as well. So
Yep.
yeah, there are fees involved for sure, but at the end of the day, if you're getting, the same amount of cake you would have gotten, then it's really not too much of a detriment to the investor.
Yeah, and I would even argue that it is to the benefit of the investor because I will tell you that I do a due diligence process on these deals that I would put up against any single investor. We're flying to properties. We've got ongoing relationships with these operators. I literally see my operators pretty much every single month in person. Those relationships are very valuable and they take time and energy and effort to build. And the cost of going to conferences and just all of the things that we're doing, like honestly, I'm working probably harder than I ever have in my entire life. And I'm doing that to create a sustainable capital raising, opportunity for my investors. So, okay. So let's see here.
Yeah, I was just gonna add, in many ways, you're investing in the fund manager more so than the operator. Like you're trusting the fund manager
absolutely
to do their due diligence.
Yep, absolutely. All right. So I noticed here, from a timing standpoint, is it correct to assume we've only got about 10 or 11 minutes left? Is that?
Yeah.
It is? Okay. So I'm going to run pretty quickly through the next two ones here. I more so put these in here, and we can, of course, show the content if anybody wants it, but very, very high level about blind fund and customizable funds. A blind fund can be used with co-GP or fund to fund, but the general premise behind a blind fund is that you're investing in the operator who, if they have a blind fund, I will say that you really are, you're betting on the operator in this case more so than ever before because you don't even know the assets that you're going to be investing in. So generally you're investing into a buy box and you're betting on the history and the track record of that operator. And the operator benefits because if they have all the capital before they go to to go to acquire these assets, their ability to close increases significantly because there's no risk to them not raising the capital. So there's benefit because they can quite often take down assets sooner. But the biggest con to investors is that you don't get to identify the asset before investing in a blind fund. And that's what really kind of brought on the next model, which is a customizable fund, which is something where you invest with one fund manager, but you do get to pick and choose what the assets are. This is a newer type of offering that's really only been in place for a couple of years. We're starting to see this become much more popular due to some players like A-Vestors and a couple others. Just traditional SEC attorneys are building these as well. But essentially you invest into a fund. Quite often you're only going to get one K1, whether you have 1, 2, or 10 different placements in those deals. But there are some drawbacks as well. The biggest drawback that I've heard from some very reputable SEC attorneys is that there is some risk to the investor having some exposure to issues that are going on with the other assets, whether you invested in them or not. I don't know if that's true or not. Those are just the concerns that I've heard from some SEC attorneys that are rather reputable in the space. So I put those in there again, more so just as a high level overview, but just know that they're available and they're out there. And I think we'll see more and more of customizable funds. And if you're thinking of investing in a blind fund, just make sure that that operator has a very long track record doing what they claim that they're going to do, because that's what you're betting on. All right, so let's jump in if we can into the example. And actually, I see a question coming in. How does fund ensure the capital for an asset if they give option to investors to choose? It's a good question, Arun. What I'm seeing quite often in these structures is where they're essentially raising as if they're doing single asset investments, but they're leveraging this from a legal entity and structure standpoint to provide the benefits of the customization. So more often than not, what I'm seeing is those operators are promoting individual asset deals within their customizable fund. But I know Keshav and team are using those as well. So maybe you can add some additional insight on that.
Let's see. How does the fund ensure the capital for an asset if they give option to investors to choose? I don't even, maybe I'm missing the question. What's the wording's tripping me up a little.
Yeah, and maybe the question is around like, how do we
know
make sure
we're
that
going to hit our capital raise amount?
potentially, yeah.
Yeah. Well, so I mean, even in typical syndications or the co-GP model, you typically, when you put out a investment offering, you'll have soft commitments from all of your capital partners, right? It's your individual investors, your institutional investors, your co-GPs, your fund managers, all of the different capital channels that you have will issue soft commits if they're interested in the deal. And at that point, you'll obviously want to make sure that you have more soft commits than your raise amount because it's a soft commit. People can back out at any point. And so the same logic applies here as well. The fund manager should be working with operators that they know can close on deals. They know the operator has a history of closing on deals and making sure that the entire cap table is accounted for. So for the most part, that really shouldn't be a problem if you're investing with the right people, which hopefully you are.
Well, and I can tell you as well, as a fund to fund manager myself, I hold on to my investors' capital until like sometimes I hold on to it right up until the day before closing because I want to have certainty that they're closing. And if we run the situation where that operator where that operator runs the risk of not closing, we can return that capital to investors without it impacting them in any way. Now, they've got some opportunity costs because the dollars have been tied up, but yeah, I make very certain that they are closing before I wire those funds to the operators, generally the day before they close. So, whereas traditional retail investors are usually wiring funds throughout the raise period. So, okay, so let's walk through an example here, and this is just the exact example that I get from one of the large operators that I work with, and this is just to give you an idea. This is just to give you an idea of what this math can look like and how to calculate that math yourself. And this is not to the penny science, but at a very high level, this is how it works. So retailers or retail investors that, and basically we're going to take a look at the example of what do the returns look like as a direct investor with the operator versus with a fund manager. So in this specific example, and this is fairly common in the space, you might see a 7% preferred return with a 70-30 split. And then after it hits some type of threshold, in this case, we'll say it's a 2x equity multiple. Sometimes it's IRR related. Then the split or the waterfall drops down to 50-50. And in this example, it was a $50,000 minimum. Okay, so 7 pref, 70-30, 50-50 waterfall after a 2x equity multiple. So in this situation, my fund would actually earn, because we're bringing a bigger check of $500,000, we would earn an 8% preferred return and an 80-20 split. Now that's what the fund is earning. That is not what the investors are earning. The investors would earn the portion that we dictate in our PPM as to what they would earn. So in this specific example, and what I generally will do is I will offer that same 7% preferred return, and then we'll offer 85% to our investors of the fund earnings. So also being with a $25,000 minimum. So the math on this means that investors are going to get the same preferred return, and then they're going to get 85% of the 80% that the fund is earning, which ends up equating to 69%. So it's 1% less than the 70-30 they're getting directly with the operator. But you'll notice that there's no second tier waterfall in our structure, which means that if and when we exceed 2x equity multiple, then the investors in the fund will do significantly better than they would have going directly to the operator. So the question becomes, is it worth that 1% difference to get the added benefit of the third-party due diligence, the better terms we're getting, the relationships that we have with the operator, and all the time, energy, effort, and expertise that the fund manager is putting into the management of the fund and the selection of the deal, when you also could potentially do significantly better if it exceeds some predetermined amount. So what I find is that the relationship between the fund manager and the investors helps to overshadow that 1% fairly significantly. And most folks have a strong relationship with the fund manager, so they choose to go that path. But I would encourage you to work with fund managers that are transparent with their fee structures and their earnings. And, you have to make that decision for yourself, whether the added benefit and added risk is worth the potential upside or downside. So that's the basic level there. Gosh, we're down to a minute of time. I apologize for talking so much, but that is the material that I have. And of course, would love to connect with anybody, schedule a call, get on my LinkedIn, call me, email me. Would love to chat with anybody more about this stuff.
We did great on timing. So to take us out, we have one question here from Arun. Have you seen the penalty? What have you seen for penalties for investors to back out?
I personally have never seen anybody charge any penalty to back out, whether it's in my fund or within my operators. I did a number of co-GPs where people had put dollars in, and the GPs that I work with were extremely gracious, and literally wired funds back the same day that I had two different investors ask for their money back. I've had a number of people back out of mine, for various, I mean, things come up. I get that. Know that once the deal's funded, it's funded. But yeah, there aren't any, I've never seen a situation where penalties were charged.
Yeah, I've had an investor back out as well, and they got their investment back also, no problem. So
Yep, absolutely.
That's why a lot of funds are just, they start off as oversubscribed, knowing that people will either not fund or will have to pull back their funds.
Yep, absolutely.
okay, well, with that, thank you everyone who attended and listened, and for those of you at home who are about to listen, thank you for taking the time with us. Thank you, Randy, for joining us today and walking us through the different different capital structures that investors could invest through and the pros and cons of all of them.
Awesome. Yeah, thanks so much for having me. This was a great exercise to run through this. So
yeah. So to learn more about capital raising structures, feel free to reach out to Randy at impactequity.net. Randy, or his email, randy@impactequity.net. We'll be uploading his contact information in the description, wherever you're listening or watching us from. So again, Randy, thank you for taking time out of your busy schedule to come speak to us in the audience. For those of you listening, don't forget to like and subscribe to our podcast, however you're listening, to make sure that we can continue bringing you the best educational content. So until next time, everyone, keep learning to invest for generational wealth.